Well, welcome back, ladies and gentlemen, to Argo Gold's channel. Basically, we're going to get some highlights for the 2023 year end, along with just some of the production on the oil frontier as well. Joining us, CEO Judy Baker, as always. Welcome back.
Thank you very much, Kyle. 23 worked out really well for Argo. In November, Argo participated in its third oil well. It was Lindbergh number 2. And so for the month of December, Argo had oil production from 3 oil wells: Lindbergh 1, Lloyd, and Lindbergh 2. Our production per day for December was 128 barrels per day. So in 2023, Argo invested 1.8 million in capital in the ground, in oil wells. And the first was our participation in Lindbergh in March of 2023. The second one, we participated in Lloyd in September 2023, and in November we participated in Lindbergh 2. So for 1.8 million in capital, we're running at 128 barrels a day for the month of December. To summarize our 2023 revenue, we on the revenue line we were 1.17 million, and our net operating cash flow was 0.82 million. So very decent numbers for Argo's first year as an oil producer.
Yeah, definitely appreciate the insight on that. How do you see this kind of ramping in 2024? What are you kind of focused on here? What should investors pay attention to?
Yeah, so for the first half of 2024, we're just going to run at Lindbergh 1, Lloyd, and Lindbergh 2. We're going to build up our cash reserves. And then in the second half of 2024, first kind of late summer, we're going to drill a second oil well at Lloyd. And then in late 2024, we're looking at drilling 2 more oil wells at Lindbergh in parallel. So we should exit 2024 at, solidly over 200 barrels per day.
So oil has obviously been kind of fluttering here. Do you want to talk about the oil prices? How do you kind of see that, and what's your perspective on it?
Yeah, okay. So interestingly enough, winter is usually a seasonally low demand period, as well as it's usually not as good of a pricing period for Canadian oil. And so we saw, materially lower oil prices, Western Canada Select in December, January, and we were looking at like a $20 US $20 differential between WTI and Western Canada Select oil prices, as well as just lower WTI. But what we've seen in February is we've seen increasing WTI, and then for Western Canada Select, from the beginning of February, there was a $20 US margin between WTI and Western Canada Select, and now we're back to like a US $15 margin between WTI and Western Canada Select oil prices. So that closing of the margin in oil prices will definitely, as well as an increasing oil price, again with seasonal demand, will definitely help Argo on the revenue line after what we've seen a weak couple of months in oil prices, and particularly Western Canada Select.
Yeah, definitely appreciate the insight on that. And I'll pass it off to the viewers. We'd love to know what you think in that comment section below. And consider subscribing, because as news and catalysts continue to hit the wire, of course, we're going to bring it to you here. But on that note, as always, we look forward to catching you in the next one.